This single insurance mistake costs the average family over $20,000 every single year. And most people are making it right now without even realizing it. Stay with me, because in the next few minutes I'm going to show you exactly what it is and how to stop throwing that money away. If you're working hard every day, trying to support a family, pay the mortgage, save for college, or just build a little security for the future, this video could literally put thousands of dollars back in your pocket. And no, your insurance agent or the big insurance companies are never going to explain this clearly to you. In fact, they kind of hope you never figure it out. So in the next few minutes, I'm going to break it down super simply. What this one mistake actually is, why 8 out of 10 people fall into the exact same trap, how much it's quietly costing you every single month, and most importantly, the dead simple steps to make sure you never make this mistake and your family stays fully protected without overpaying. All right, let's get straight to it. The single biggest insurance mistake that costs families $20,000 or more is buying the wrong type of life insurance policy for their actual life situation. There are basically two main kinds of life insurance that matter to regular families. Term life insurance. This is pure protection for a specific number of years. 10, 20, 30 years, whatever you pick. It's cheap, it's simple. It does exactly what 95% of families actually need: whole life or any permanent insurance. This is insurance plus a forced savings account built in. It costs 5 to 15 times more every month, and the insurance company keeps most of the extra money you pay. Here's a real quick story, so you can feel the difference. My friend John is 35, married to little kids. This makes about 85 grand a year. 10 years ago, he sat down with an agent who told him, "John, you're a family man now. You need something permanent that grows cash value." John trusted the guy. We signed up for a whole life policy. His monthly payment is $480 a month. That's $5,760 per year for 10 straight years. $57,600 total so far. Now fast forward, John's healthy, kids are growing, mortgage is still there. But guess what? If John died tomorrow, his family would only get $500,000, the exact same death benefit he could have bought with a 30-year term policy for about $48 a month. Not $480, that's $432 extra dollars a month every month. For 10 years, over $51,000 gone, and the cash value the agent promised, after commissions and fees, it's barely $20,000. John literally paid $51,000 to have $20,000 in a savings account he can't touch without penalties or losing his coverage. That's the mistake in real life. So why does this keep happening to good, smart people? 3 big reasons. First, insurance is confusing by design. The contracts are hundreds of pages long, written in language nobody understands on purpose. They use terms like paid-up additions, non-direct recognition, internal rate of return. It's a foreign language. Most people just glaze over and trust the agent. Second, agents make massively different commissions. If an agent sells you a $500,000 20-year term policy for $40 a month, they might make $400, $600 total commission one time. If they sell you that same $500,000 whole life policy for $400, $500 a month, they can make $15,000, $25,000 in first-year commission alone. That's not evil. That's just math. Guess which one most agents push when they have bills to pay? Third, emotional selling at the exact wrong moment. You just had a baby, your parent passed away, or you just bought your first house. You're feeling vulnerable, the agent says. Don't you want something that lasts forever and never goes up in price? You're not thinking about spreadsheets. You're thinking about your family. That's when the expensive policy feels like love instead of math. Let's put real numbers on the screen so you can see exactly how expensive this mistake is. Average numbers for a healthy 35-year-old male, non-smoker, $500,000 coverage, 30-year term. $42, $55 per month whole life, same coverage, $420, $550 per month. That's a difference of roughly $450, $500 every single month. Over 30 years, that's $162,000, $180,000. In extra premiums, even if you only keep the whole life policy for 15 years and surrender it, you've still overpaid $80,000, $90,000. You usually get back less than you put in because of surrender charges. But it gets worse. That extra $500 a month you're sending to the insurance company could have been invested somewhere else if you took that same $500 and put it in a simple S&P 500 index fund, averaging 8 to 10% over the last 30 years. That money would grow to over $600,000. $750,000 by the time you're 65 while still having the full $500,000 term coverage in place, so the real cost isn't just the $170,000 in extra premiums, it's closer to $700,000. $800,000 in lost wealth over a lifetime. That's why I said $20,000. A year on average for families who are in the wrong policy, because when you spread that lost growth over 30 to 40 years, that's what it works out to per year. K. Enough pain? Here's exactly what you should do instead. For simple steps. Step 1. Know your real goal. Ask yourself one question. Do I need insurance for the rest of my life? Or just for the years my family would be destroyed if I died? For 95% of people watching this, the honest answer is the second one. You need it while the kids are home, while the mortgage is big, while your spouse would struggle to replace your income. Once the house is paid off, kids are grown, and you have investments, you don't need life insurance anymore. You become self-insured. Term matches real life perfectly. Step 2. Match the policy length to your actual obligations. Kids under 10 gives, get at least a 20 or 30-year term. Big mortgage left gives. Make sure the term covers the remaining year stayed home. Spouse gives still need coverage on them too. People forget this. Step 3. Buy the right amount. Quick rule of thumb, 1015. Times your annual income, plus any remaining mortgage balance. So if you make $100,000, aim for $1 to $1.5 million in coverage. It's still crazy affordable on term. Step 4. Review it every 2 to 3 years or when life changes. Rates have dropped dramatically in the last decade. You might be able to lock in an even lower rate today than you did 5 years ago even. If you're older and rates went up a little, the industry drop usually more than offsets it. Just help my brother drop his payment from $92 to $51 a month for the exact same coverage, just by shopping it again. And here's the best part. You can get real term quotes from top-rated companies in about 90 seconds online now. No agent. Number pressure, number 45-minute appointment. I'll put my favorite free quote tool in the description. So let's recap everything super fast. Buying whole life when you only need temporary coverage is the mistake that costs families $20,000 plus every year in lost money. It happens because the system is confusing. Commissions are massive, and emotions run high. The fix is simple. Buy term, match it to your real obligations, and invest the difference yourself. Review every couple years, and you'll keep even more money. If you want more dead simple explanations, like this about insurance, taxes, it's investing stuff that actually moves the needle for regular families, hit that subscribe button and the bell so you don't miss the next one. This video is for educational purposes only. Everyone's situation is different. Insurance policies and rates vary widely by state, health, and carrier. Always read the actual policy terms and conditions before making any decisions.